Well, folks, the discussion around valuations has significantly increased this year as the stock market realized the importance of paying a fair price. But in a contrast to value stocks, growth stocks have always been very difficult to value by traditional fund managers because obviously most of these companies are simply not profitable. So what happens if you try to value a stock like Plug Power, which grew its revenues by 95% last quarter with this value investing methodology? Well, that's exactly what we're going to cover in this video. But before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So I want to start things off by actually addressing an important catalyst that we recently learned about just yesterday, which actually caused a lot of clean energy stocks like Plug Power to skyrocket around market open and throughout the rest of the day. And that is because the White House recently included a massive Defense Production Act in their press releases. And as you can see, one of the critical components of this act is investing in electrolyzers, fuel cells, and related platinum group metals, which are a form of rare earth metal that are used in the manufacturing of those technologies. So if this administration actually takes action on this act and we see some sort of change in the way that we're adopting clean energy over the next few years, then a stock like Plug Power will benefit massively. But regardless, let's now get into the valuation analysis of Plug Power.
Investors are desperate for a good earnings call out of Plug Power. However, looking at the last year, things are not looking good. The stock is down 61% from last year. And if you look at the last 6 months, it hasn't got better, down 25.76%. And in the last month, down 7.29%. So the question is, as an investor, should you remain invested in the stock? And if you're looking at the stock currently, what is the basis for your decision-making process? Well, I'm going to walk you through my personal detailed stock screening process and walk you through some of the metrics that I'm looking at and help you make sense of the stock. Now, first of all, straight off the bat, a big area of concern for me is the enterprise and market cap values. The enterprise value is sitting at 7.4 billion. The market cap is sitting considerably higher at 11.4 billion. That suggests there may indeed still be a bit of sentiment around in the stock. Now, looking at the insider holding, really good to see this number, 10.2%, and institutional holding sitting at 54.8%. The reason why we like to see those numbers, it is a good vote of confidence when insiders are holding the stock as well as institutions. Now, the area that's got everybody talking and concerned is the short interest, which has grown dramatically over the course of 2021. In fact, it is up to 12%. In fact, that means that of all outstanding shares, 12% of the stock is currently shorted. Now, that may indeed be retreating over the next couple of months as we might be seeing the bottom. But of course, we have to focus on the revenue numbers, which looking at the absolute bottom line revenue number, which is free cash flow, it's not looking good. Negative 480.4 million. Now, let's talk about some of the risk factors. The company is currently unprofitable and losses have increased over the past 5 years at a rate of 51.5% per year. This is pretty dramatic. And then compensation for executives have increased despite the company being unprofitable. So as an investor, if I were invested in the stock, which I'm not, this is something that would truly irritate the hell out of me. I do not want to see executives being paid out of shareholders' investments.
So the first thing this person mentions is the fact that the market cap of Plug is higher than their enterprise value. Now, the reason this is the case is because Plug has basically non-existent debt on their balance sheet, and they have around $4 billion in liquid cash and short-term investments. And the reason why that is a good thing is because typically an enterprise value is calculated by adding the company's debt to their market value and subtracting their cash position. Because in the future, if Plug Power was to get acquired by another company, they would have to pay off all the debt that the company has, and obviously the cash position they have is just an added bonus. So that is typically subtracted from the price tag that another company would pay to buy out Plug. And so it's very healthy if the enterprise value is lower than the market cap. And following that, another thing I really like about Plug is their short interest, which is sitting at a very attractive 12%. Now, this person mentions that a high short interest is typically a bad thing. And on paper, if you are just looking at the sentiment, then yes, it is, because it means that a lot of people are not optimistic about the company. But for me, a high short interest adds an extra level of value to the company, because it means that a lot of people potentially don't understand the business as well as I do, right? If the short interest of a company is less than 1%, then I don't personally think I have any edge investing in that stock, because typically most people will be betting against the company instead of betting with it if the technology was not that well understood. And this brings us on to the part of the slide that I most agree on with this individual, which is the fact that Plug is obviously unprofitable, and the fact that their compensation for executives like the CEO and the CFO have actually increased quite significantly over the past 2 years. Now, obviously, not every single stock I invest in is going to be perfect, and ideally, I would like to have a little bit less compensation in direct cash as a salary or through stock options for executives in a company like Plug that is obviously not profitable right now and has still a lot of execution ahead of it. But again, I do understand that this stock has skyrocketed since 2019. The stock was trading around $2 a share back then, and now it's obviously well over $10 a share and hit highs of around $70 a share in early 2021. So it somewhat does make sense for someone like the CEO to get compensated, because he's obviously been the CEO of this company through a very tough time throughout 2010 all the way up to 2020, which is when the stock basically did nothing. But regardless, let's continue on to see what else this person has to say.
So this brings us into our pricing models. Now, looking at the free cash flow, they are sitting in a negative multiple, and that is obviously because they have negative free cash flow. Looking at the EPS, this is also going to be negative, but if we were running a DCF model, we'd discount in at 10, we'd project growth out at 5 to 15% on a fair target P of 5, and looking at the current pricing structure, you're going to see some huge disparity. The current price is sitting at $19.81, and for some reason, it's beyond me, the analysts believe that this stock is going to be worth $41.58. Personally, I think that number is very bullish, and most of the analysts tend to be overly bullish. In fact, we take the analyst consensus with a pinch of salt. Now, looking at the free cash flow valuation, it is negative. Looking at the DCF on earnings per share, that is also negative, but there is one glimmer of hope, and that is that the enterprise value is not sitting too far off the current pricing. In fact, it's still a fair margin, $15.61 to $19.81, but it does mean that there is some value in the business at least. And of course, if you are looking to buy in, you need to price in accordingly. So my personal verdict on the stock, where I'm coming out, is as follows. I believe the stock is going to settle at $12.50 over the next 12 months. That means there is a projected loss on the stock, and because of this, I have a sell sentiment out on the stock.
So the first thing I really didn't like about this person's analysis is the fact that he's looking at free cash flow as a metric to value this company. Now, free cash flow is essentially the money the company has left after they've done all their R&D, their capital expenditure, and financing activities. And so would you really expect a company like Plug Power, which is very high growth in a very competitive sector, to invest all its money in making sure they have free cash flow, which is typically something that's done when the company is already very big and they're just trying to return their investments to shareholders? Instead, this company has to spend a lot of money on R&D and capex to keep their competitive advantage. So it's very difficult to expect a company like Plug to have a free cash flow in the first place. And then the second thing I really didn't like is the fact that his fair target PE is $5, which in my opinion is ridiculously low for a high growth company like Plug, which is growing revenues by around 95%. And starting 2023, this company will have positive free cash flow, although it's going to be very small. And so that should, again, raise the PE of this company, as investors will see profitability coming down the road much faster. But anyways, guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below your guys' thoughts on this person's analysis on Plug Power. I definitely think that using a value investing approach is not the best when you're trying to analyze a growth stock. And I think that's the reason why this person has a sell rating on Plug and why his price target is very, very low. But anyways, guys, I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.